Welcome back to the channel. My name is Brad, and today we have a special guest from NEOS on the channel. Troy, go ahead and introduce yourself.
Happy to be here, Brad. Thanks for having me. So I am a co-founder and managing partner of NEOS Investments, and we issue option-based ETFs. We currently have 12 ETFs in the marketplace, and happy to come on and chat about those.
Awesome. And most viewers of my channel will already know something about NEOS because I pretty much talk about them every single week. But let's go into percentage of portfolio written on. How does that vary from month to month in the decision-making process of that?
Sure. It's a good question. I think we'll use SPYI as an example, but it kind of applies to a lot of our high income products. When you're thinking about a product like SPYI, you're long all 500 names of the S&P 500, and then you have this option overlay where we're selling S&P 500 index calls and rolling those on a monthly basis. We roll those at the end of the month. Duration is a little longer, so when we're closing those out the following month, there's a few weeks before they would have expired. And so when we're rolling those, our models are looking at a number of things. They're looking at volatility, where it currently is, the rate of change of volatility over the past month, and a few other factors to decide not only how much notional we should write on, meaning what percentage of the portfolio should be written on, but also how far out of the money those calls should be written. And that can change month to month, given that volatility changes minute by minute. So it's one of those things built into our model. All of our strategies here are rules-based and systematic on when we roll them, how we roll them. We follow that model. So there's no discretion taken by myself or the other portfolio manager here and saying we should close these calls or do something different. We follow our process and make sure that our models are being followed on a daily basis. But yes, at the end of the month, think about it like this. If volatility is higher, you could bring in more premium by writing short calls. So what does that do in our portfolio? It might say you should write calls further out of the money. And it also might say you should write calls on less of the notional. That gives the portfolio more of an opportunity to catch upside when the market's moving higher. To give you an example, right now, SPYI is about 70% covered in the portfolio, given that leaves about 30% of the portfolio that's not covered by short calls. So if the market moves higher and moves through those short call strike prices and continues to move higher, there's a portion of the portfolio, that 30%, that can continue to move higher with the market. And we really want to, when we look at these products, we not only want to provide monthly income in a tax efficient manner, but we want to make sure a few things: that the total return is, that the product is capturing a lot of the total return of the underlying reference asset, whether that's the S&P 500 in SPYI or the NASDAQ 100 in QQQI or one of the other funds. And we want to make sure we're capturing a lot of that upside movement of the underlying reference asset, provide that monthly income, and then provide that tax efficiency. We want that net after-tax distribution to be as close to the gross distribution as possible. So when you get that 1099 at the end of the year from your broker and you get that brokerage statement, we want to see how we can provide a more tax-efficient income.
But why do you use the ladder call strategy versus just a single call?
For us, as we did our testing, we do everything in-house here, do our research and development as we're thinking about different option strategies on different asset classes. When we were building these strategies, we saw that if we laddered out the calls and kind of split the notional, so for example, we'll use SPYI again, if it's saying that 70% of the notional should be covered, then we were splitting it, 35% was going into one strike, 35 into another. It gave you more upside appreciation when the market moves higher. And we got to see that if you ladder it out a little, you also can have a portfolio that over time, during that month period where we have those calls on, we can capture more of the premium written.
So when I read the prospectus, especially we'll just stay with SPYI, there's an optional call spread that you could actually write. Have you ever written that optional call spread?
So since inception, we have not. We put it into the prospectus because we saw that during our testing, there could be periods of time where volatility is very low. And during those times, we would have to write calls closer to the money and possibly on more of the notional of the portfolio. But also in those times, we saw that there were periods where the market would then move higher. And we didn't want to cover too much of the portfolio and have it not participate with the market. So we put in this provision where we could put in a call spread where we're selling a call closer to the money to bring in enough premium to give you that distribution. and then take a small portion of that premium and buy a call further out of the money. And during those times, we saw that if the market moved higher, we could participate if it moved past that long call. So for us, we wanted to make sure that was in the prospectus, but you're correct. Since inception, we have not been in an environment where the model changed it over to the call spread from the short calls.
Thank you for clarifying that for me, because I would have thought it would have been higher volatility, but I guess that's when you write the calls farther out of the money. And lower volatility, you'd have to be closer to the money. So that really makes sense to me. Benefits of holding assets versus using synthetics. And you do use synthetics on a couple of your products.
Correct. So if you think about SPYI, QQQI, if you look at the holdings file, which anybody can pull up on our website on a daily basis, you'll see SPYI has all 500 plus names of the S&P 500. Same weighting. We're not trying to do anything differently there in our underlying reference assets, whether it's the S&P 500, the NASDAQ 100. For IWMI, which is our Russell 2000 products, we do buy an ETF, and we do that because there's, as the name says, there's 2,000 names or so in that index. And we found as we have inflows in, if there's not more than one or two creations coming in, you can't really divide that up amongst the 2,000 different stocks in the proper weighting of the Russell 2000. So we buy one of the lower cost ETFs to get that exposure. Then if you look at, say, BTCI, our Bitcoin product, or our newer gold product, IAUI, which is our gold high income ETF, if you look at those, we're doing things a little differently to get the long exposure to, say, Bitcoin. We'll start with for BTCI. We have up to a 25% position in one of the ETPs that are out there. We currently have it in HODL, since that's the lower cost one. And then to get synthetic, the rest of the position, the other, call it 75% of the long position, we do a synthetic long through the options. So for BTCI, we use the SIBO Bitcoin US ETF index options, which we either trade CBTX or MBTX index options. And when we trade those to get that synthetic long, we will buy a call, sell a put with the same expiry and the same strike. That'll give us a delta one position to the underlying index, which is tracking those ETFs, which is tracking Bitcoin. So we are getting that delta one position. So if the Bitcoin moves up 1%, our position net should move up 1% and vice versa. So between that 25% ETP position and the 75% synthetic long, we have a long position, and then we're writing calls out of the money.
Can you go into the concentration limits of BTCI and IAUI?
Sure. So I'm assuming you're talking about that 25% position. So that is, if you think about BTCI or IAUI, these are ETFs. They are 40 Act funds. But within a 40 Act fund, you cannot have more than a 25% position through a CFC, which is a controlled foreign corporation, which is a Cayman entity. You cannot have more than a 25% position in an ETP. So for the Bitcoin, whether it's any of the, Bitcoin, as people say, ETFs, but they're all ETPs, they're 33 Act funds. So any of those will put off bad income if they distribute anything. And an ETF cannot put out bad income. So what we'll do is own it through a Cayman entity, but you have that 25% cap. So same thing with IAUI, you'll see that we're long AAAU as the, call it CFC position, the controlled foreign corporation position, to get that long. And then we trade GLD flex options to get that synthetic long for the balance. So for us, we find it's a little different than what others do, but we find it's nice to have a mix between that pure ETP position plus the synthetic. Makes a lot of sense in the portfolio that we've seen.
Is there any pros or cons holding the underlying than using synthetics?
I think for the ones where we can get easy access to the names, whether it's SPYI and owning all 500 names in the S&P 500 is very, very easy for us to do. It's low cost. We'd rather do that than buy one of the low cost ETFs. It just makes more sense. Same thing with QQQI for the NASDAQ 100. We went through IWMI. For us, if we can get easy access and it's more cost efficient to the fund, which is more cost efficient to the shareholder in the end, it makes the most sense. Where you can't get easy access to it, We find doing a synthetic via options makes a lot of sense because you're still getting the underlying move. You just don't get all the tax benefits. So if you think about SPYI, we're along this basket of 500 plus names, and outside of some rebalances here or there, anytime we have flows, they're coming, through the ETF process. They're either coming in kind or redemption in kind. So those are very tax efficient. The ETF structure in general is a very tax efficient structure, transparent and tax efficient. And owning all those names is not only a tax efficient way to do it, but we're holding those names. And so we don't have any, realized P&L within the portfolio if we're not trading those names a lot. Whereas the synthetics, you're rolling these option positions on a monthly or quarterly or so basis, and that can create different P&Ls within the portfolio. So different from a tax perspective.
Before we started, I told you that I was actually tracking these. How accurate am I on my math on, let's say, a SPYI on a percentage? Am I fairly close, or am I missing something?
No, the ones I've seen recently, you are fairly close. So when you're thinking about, you got to go through the math, which is nice. When you're thinking about it, in SPYI, we have two positions, two short call positions. And the best way to do it is just take the number of contracts, multiply it times the price that you see. You could pull that up in our holdings file.
Yes.
And multiply that times 100 for the multiplier for options contract. And then you'll see what that notional is. And if you do it for both positions and then add that up and divide it by the total amount of AUM in the fund that day, you can kind of see what percentage notional coverage there is. So it's a great service there that you provide a lot of your viewers.
In my mind is I call it close enough because, as you mentioned, there could be creation units, other things coming in with the fund. And I don't do it every day. I actually do it at the end of the month. Let's talk about SPYH. And what I really like to get into, and I want to make sure that I'm correct on your put spread collars that you're using. Right now you have, for everybody's understanding, you have a short call at 655, and that's only on a portion of the SPY, so it's not fully capped. But you bought the 54.55 and you sold the 48.85. At least that's according to your website, which anybody can go download. So I encourage people to figure that out and look at this yourselves. As the index moves down and it goes through that 54.55 that you bought, now you're actually in getting some type of protection. Am I correct?
Yeah. So when you think about it, we wanted to bring out a product that would have a lower vol than, say, SPYI. So it's going to provide a little bit lower income, but give you a measure of downside protection. This is not a hedge to zero type product, but on a monthly basis, as we roll this, you'll have a measure of downside protection. If the market is volatile, has a sell-off, maybe like we did in April, and you'll see that outperformance versus the S&P 500, but of course also SPYI. So yes, we're selling a call to bring in premium, and then we're using a part of that to buy a long put. And as you said, that put was, when we rolled it, was about 7% out of the money. And then we sold a put further away that was about 15, 16% out of the money at that time. And between that spread, for the long put and the short put, you'll have some protection there. Now, also, if you think about it, if you roll this product, we roll it at the end of the month, and then the market starts selling off the next day, that premium also that we brought in also gives you a little bit of protection or buffer on the downside before you even hit that long put spread. So from a total return perspective, it's a nice product that gives a good distribution on a monthly basis and can give you that measure of downside protection. It's really for people that, maybe they like the S&P 500, they look at SPYI, they like the distribution, but it's still maybe too much equity risk for them, because an SPYI is only going to protect you on the amount of premium we bring in on a monthly basis. So if we bring in, 1 to 100 to 125 basis points on a month, that's what it's going to give you in protection. If the market sells off, it's going to outperform the S&P 500 by that much. But as people that want to be involved in that, but maybe want a little bit more protection, still want some income, but they're willing to give up some of that income for a measure of downside protection.
Yeah, and would this not move slower than let's say a SPYI? So you're not going to see the same types of changes in daily price?
Yes, yeah, it'll have a little bit less volatility than a SPY. But then again, on the market moves higher, like you said, we're not covering 100% of the notional, so you can participate with a lot of that movement higher. We're still writing that one call out of the money. I believe when we wrote that call at the end of the month, it was over 2.25% out of the money from where spot
Yep.
was. And then after that, you're still not covered on 100% of the notional. So it should be able to participate in those upside moves. And then when it does come in, that long put spread should give you, that measure of downside protection to, give you a little bit lower of a vol and outperformance when the market's moving lower.
Quickly transfer into some of your other products that you have. You have Cashy as a product, and you have one on long-term bonds, which I just roll my eyes going, I don't buy long-term bonds in this marketplace. Maybe for some people, not for me. In Cashy, how does that actually work with your getting a little bit extra on short-term treasuries?
Sure. So CSHI, which is our enhanced 1 to 3 month T-bill ETF, you'll notice across our fixed income suite, all the names kind of change. They're all enhanced. And the idea is, how can we give you a risk adjusted return with a little bit more of a distribution than you're getting off of whatever underlying the 1 to 3 month T-bills, the 20-year plus, aggregate bond, high yield, give you more distribution from an option portfolio. And this we're doing differently than all the high income stuff that we talked about before. This we're using the put side of the option chain, and we're selling S&P 500 index put spreads. So if you think about how CSHI works, we're long portfolio of 1 to 3 month T-bills. And as you know, those are yielding just over 4% right now, but those will change with interest rates. If the Fed decides to cut, those will come in. And as we've seen over the past couple of years, those have gone from yielding close to zero to now 4. They were over 5% at one point. But the idea is, how do we build an option portfolio and be able to provide income or premium on a monthly basis to distribute out? And so we developed this S&P 500 index put spread strategy that we roll on a weekly basis. Duration's a little longer. And with that, when we roll, we're rolling usually for CSHI in 4 different put spreads that are spread out deep out of the money, anywhere from 8 to 12% out of the money usually. And we're bringing in premium every week, or most weeks as the market's moving higher. Because you think about it, if you're selling S&P 500 index put spreads, you're giving yourself more of a long equity bias. You're introducing equity risk into a fixed income portfolio. And for us, that's where you could source from that volatility of the equity market. You could source the income from the options market. So as we bring in that premium, we distribute that out. So we only really distribute out the amount of option income we bring in, and also anything that we're making off of the T-bill. And so this is one of those products where we like to have it be a low vol portfolio, just to provide that additional. And if over time, it looks like it provides an additional 1 to 1.5% over whatever T-bills are doing. So right now it's just over 5%, giving you maybe about 1% over whatever the T-bills are doing.
Very nice explanation. Let's talk about, I'm really going to jump around on you today. Let's talk about IAUI. And you just came out with this. Are you able to disclose what it's going to pay as a percentage, or what you're targeting?
So I can't disclose any of that yet because we have not had our first distribution. So our first distribution, we go next week on the 25th, and we'll have those numbers out. This is one of those products, again, and we talked about it earlier, where we get that long position from an ETP and also synthetically, and then we're selling calls out of the money. So to give you an idea, when we first rolled it, we sold calls, the latter calls were anywhere from 2.25% to 4.25% out of the money. We brought in that premium, and the goal is to distribute that out, come distribution time when we go to the X date on the 25th.
So some smart YouTuber might be able to take your first day Excel spreadsheet, extrapolate exactly how much you made on those, and give you a estimated percentage. You can.
I'm sure somebody who could figure out the math could look through that and give a good estimation.
I think my estimation was plus or minus 1%. I'll just say that. I was very close with your one on REITs. Talking about REITs, I did see a tweet from you guys the other day or on X about that particular product. And it was talking about if the Fed lowers rates, which they may or may not do, we do not know, how has that affected REITs in the past?
So if you think about it, it could definitely be a positive, potentially a positive effect on it. When rates come in, people can refinance, people can think about investing in real estate again. So it's one of those sectors that tends to, over time, potentially do better when rates are lower. We'll see what the Fed does. It does not seem like they're going to do anything this month, but maybe towards the end of the year they might do something. But for us, it's really, falls into our alternatives bucket where if you want to invest in real estate, you want that to be a part of your portfolio. We have a portfolio of about 65 names. We're tracking the Dow Jones US Capped Real Estate Index, which is the same index that IYR tracks. And then we're using IYR flex options to sell those calls out of the money on a monthly basis and distribute out that income. So it's really, a place where you could invest. And maybe sometimes a lot of people look at this as I need to be invested in real estate through REITs, but I want to earn some income while I'm waiting for this market to turn around.
Let's get a little more technical here. Let's talk about 1256 contracts and maybe some of the lesser known rules. So, who determines the 1256 contract, or how do you determine if it's a 1256 contract when you do your publications, if it is? Because right now, my understanding, BTCI is not a one, and IAUI is not a 1256 contract.
Correct. So for IAUI, we're trading the ETP GLD options. So GLD, as many people probably use it to buy and sell and get their exposure to gold. Those are options. When I say flex, we're trading flex options, which you can have the flexibility to change either a strike and expiration from what's listed out there in the listed market, or you could change how it's settled. We like to do it to change settlement to move it over to cash, so we can't be called away if the market moves higher in gold and moves through our short call strikes. So we like that flexibility, if you will, to not be able to be called away, which is one of the main benefits that we look at when we're trading index options. There's a number of benefits, but if you're thinking about those 1256 contracts, those are not determined by us which ones are 1256. Those are really the issuer. So when SIBO puts out a new option chain like they did with CBTX and MBTX, they're the ones that kind of go through and say there's a number of rules that they have to follow to say if it's a 1256 contract, is it a broad-based index, and so forth. And they're the ones that can say whether or not it's 1256. So when you're thinking about 1256 index contracts, you're thinking about our other products, whether it's SPYI with SPX index options, QQQI with NDX index options, IWMI with the Russell 2000 RUT index options. And those are broad-based indexes that get that 1256 rule. So the big thing with the 1256 rule is really around the tax efficiency with it. With the 1256 rule, it says that taxes are 60% long-term cap gain, 40% short-term on the P&L, no matter the holding period. So if you think about if we're rolling some of these products weekly, some of them monthly, some quarterly, in any other way, if we were using a swap, an equity linked note like some use, single stock options, or even ETF options, those would all be considered 100% short-term cap gains. And so for us to get that 60-40 split is a big difference at the end of the year when you go through the taxes on these products.
One thing that we were talking about earlier when you started, you were a smaller organization, and you've now grown to how large has NEOS grown to?
So yeah, when we started, there was 5 or 6 of us that had started the business, and now we're up to 26 individuals working here. Most people are in the office. We're located in Westport, Connecticut, and for us, it's one nice to have everybody in the office. Whether it's the trading team, we have 3 very experienced traders on the desk with all 20 plus years of trading experience that have traded everything from obviously options and equities to futures and other derivatives. And then we have our sales staff, and then of course the business staff and the management team. So having 26 people in the office, from where we were a couple of years ago, is nice.
Let's get back to the 1256 contracts. You listed off SPYI, QQQI, and IWMI. Would not QQQH and SPYH be 1256 contracts?
Correct. So for those, we're using the S&P 500 index options for SPYH, and for QQQH, we're using those NASDAQ 100 NDX index options. So all 1256 there. And then all of our fixed income suite. So whether it's CSHI, which we talked about earlier, our 20-year plus in TLTI, our aggregate bond in BNDI, or our high yield in HYBI, those are all using SPX index options. So those all get that 1256 rule on any income produced off the option portfolio as well.
Thank you for clarifying that. I wanted to make sure everybody was aware of those other products that use those for you. Is there anything that you'd like to tell the audience? Or I haven't seen any prospectus right now being filed with the SEC, or should I go be looking a little bit harder?
I'd say sometime over the next week or two, we'll have another new filing out there. So we're excited to get that one. We can't talk about it until it's actually out there, but we're excited to have, we have 12 ETFs, as I said earlier. We've grown a lot. So we're excited to continue to grow that. So we look at ourselves, if you think about your asset allocation, we have equities, high income equities, we have hedged equities, we have alts with Bitcoin and gold and real estate. We have our fixed income suite with high yield and aggregate bond. And then we have our treasuries with shorter duration, 1 to 3 month, longer duration, 20-year plus. We really look at ourselves as a solutions provider. And as we bring out more funds, we're trying to slice up that asset allocation pie. So an advisor or an individual can look and say, I'm looking for income and I need it in this part of my, income bucket. And that's, NEOS will have that product. So we're looking to continue to slice up that pie and continue to bring out good products all within the space. NEOS stands for Next Evolution Option Strategies. So for us, it's really what we focus on. We're option managers at heart. And, I'd say, as anyone viewing this interview, education is key. The space has grown so much. I know, Brad, we were talking about it earlier, how many funds are out there now, how many are coming out every day. And I say, just do your homework, take the time, understand what you're investing in. An ETF is a great structure. It's transparent, it's tax efficient. You can buy and sell it throughout the day. If you get into something you don't like, you can always exit the position. And you could always look at what the holdings are. You can go to our website and pull up, just like Brad does, pull up all the holdings and see the equities we're holding, see the options we're holding, and understand what we're doing. And that's a great part about owning an ETF is that transparency. So spend your time, understand what you're investing in, do your homework, and we'll continue to hopefully come on to talk with Brad about products that we're bringing out so we could educate more.
Troy, I really appreciate your time today, and I look forward to the next time you come onto the channel.
Thanks for having me.